You could write 20 to 30% more business when you quote earthquake on every homeowner's risk. Arrowhead General Insurance Agency. Get your insureds ready for the next big one.
Calling today's market a hard market would be going too far, says Michael Miller, President and Chief Operating Officer of Scottsdale Insurance. As the economy improves, so should rates, but probably not enough to offset interest rate declines or claim costs, he adds in this interview with Insurance Journal's Andy Simpson. He also assesses Scottsdale's own performance in 2011 and 2012.
I think we do see it firming. Using the word hard market's probably a little aggressive, but firming definitely pretty much across the country. There are a few spots that are obviously firming more than others, which would be coastal property, cat-exposed property. But I'd say overall the market certainly is not declining anymore, and in some cases we are able to increase rates on certain lines in certain territories. So if you have an area that obviously was hit by a lot of cat activity, tended to firm the market, in some cases even harden the market. But even in cases like Florida, where there seems to be a need for capacity, you don't also see corresponding rate increases. So I think it's a very stable market with some level of increases, but not every product, not 100% across the board. I think I would anticipate a continual climb out, and I've talked about this. It's not that we're going to see a hard market occur because of an event. At least it doesn't appear to be. But what we are seeing is a firming of the market, and I think that's a healthier way to go. With 9/11, we saw a big spike up and then a big spike back down a couple years later. So this may be a more sustainable market where we can see some increases in pricing in the 5 to 10% range, and it'll be more sustainable over the longer term. The economy certainly is impacting that. I think with the economy sort of dragging along, companies are hesitant to push hard on rates because obviously it's going to be a difficult sell. Everybody is working very hard to survive the current economy, and so as the economy improves, I think that gives a little bit more room for increased rates, which are needed in our industry. We are not certainly making the rates of return that we ought to in almost any part of the P&C industry. Of course, the standard companies obviously have to file rates, and it takes a little bit longer to put rates into effect. But I do think they've been increasing rates as well. But there's a lot of capital, there's a lot of competition. So when you look at how much rate you can increase by, obviously it's going to be dictated by competition. And since there is a lot of capital, there's a lot of competition, it does keep a damper on the ability to raise rates. But I think also the flip side of that is everybody's feeling the same thing. They're seeing lower interest rates, they're seeing an increase in weather cat activity, the combined ratios are increasing. So if you can't put any rate into that equation, your results are just going to continue to deteriorate. So I think there's a lot of pressure to increase rates, at least to the extent possible within the market. I think the economy will be stable. I don't think anybody's predicting a run-up in the economy. A few naysayers are actually saying we could go into a recession next year. One would hope that doesn't exist or doesn't occur, but I think we'll see a stable market, much like this year, with the ability to produce some rate increases. But at the end of the day, the rate increases probably won't offset the decline in interest rates and the increased cost of claims and inflation factors. So I think it'll be a stable year, but I don't think it'll be a robust year. We did well on the growth side. It was the first year out of the last 4 where we were actually able to grow. We grew about 13%, and it was across the board. It wasn't a particular line that really shot up. On the bottom line, we actually exceeded our plan. Part of that was we didn't have a lot of hurricane activity. That helped. The other part was the non-hurricane weather losses were higher than we expected. So all in all, when we added that up, 2011 was a pretty good year for us. It was a good rebound year for us after the last 2 or 3 years of practically no growth and working real hard to achieve our net income targets. So weather losses have been our biggest challenge this year from the standpoint of hailstorms in Texas and tornadoes, etc. So we have probably been hit a little bit more than typical, but again, that just tends to be where does the storm hit and are we exposed in that area. So we think we'll end the year, we're up about 14% right now on premium, so we've seen some good growth again across the board. Our weather losses are up. We think, barring no further hurricanes this year, we'll have another decent year on the hurricane front. We had the one that came up through Louisiana. So all in all, I think we'll end the year up on premium and pretty close to our net income plan.